Good morning, everybody. Welcome to this webinar entitled Working and Living in Mauritius. My name is Mark Korten. As a small introduction, I am an ex-South African, born and bred in South Africa, qualified as an attorney and practiced particular commercial and tax law in South Africa for some 15 years. Before deciding to emigrate to Mauritius, which I did with my family and young kids in 2008. And I've been quite happy working in Mauritius since then, become quite acquainted with the various laws that affect expatriates such as South Africans like myself that moved to Mauritius. So I think I have the necessary expertise to see the South African angle and the Mauritian angle in terms of explaining to you some of the laws that you need to be acquainted with in making a decision whether or not to actually move to Mauritius with your families and make Mauritius your home, at least for a period of time. So in this webinar, I'm going to be going through an overview of residency rules, how you get the right to live here and work here. The tax laws, obviously that's a focus because Mauritius traditionally or in the past has been seen as quite a low tax jurisdiction and not really that low anymore. And I'll explain to you in more detail as we go through it. And it's very important to plan your affairs, particularly in terms of personal income taxes. I'll also give you a personal perspective of living in Mauritius. That's it's not a professional perspective, it's just my perspective and also my observations, having dealt and spent a lot of time socially with South Africans who have come to Mauritius over the last 12 years that I've been here, some of whom who have stayed and are very happy here, some of whom have not stayed for various reasons and have either gone back to South Africa or ventured elsewhere, and give you some indications as to why that may have happened. Also, I think it's important, a lot of, in this COVID period we're in and in the poor state that South Africa is in amongst other countries, a lot of South Africans are looking, unfortunately, at making another country their home, whether it's for safety or for looking at the future of their children or just looking at financial issues that may influence that decision. Mauritius has marketed itself quite a bit in the last 6 to 12 months as a jurisdiction to live, work, invest. I feel a lot of those presentations have really been fairly one-sided and looking at all the positives of Mauritius whilst skirting around some of the issues that make Mauritius not so attractive or less suitable depending on your preferences or your situation. I'll try and give you a more unbiased view and state the facts in terms of explaining to you the good and the bad. So that's what we're going to do. Just so that you know, this is actually a pre-recording. I pre-recorded this this webinar the day before that it's published. So on the Tuesday, you're seeing it now on the Wednesday. I will, however, hopefully be online live to answer any questions that you may post during this presentation. Otherwise, you're also most welcome. You will see my details at the end of the PowerPoint presentation. You're most welcome to contact me if you have a quick question that you would like me to answer. I have no problem doing that. Also, it's worth noting that the PowerPoint slides that you'll be seeing as we go through the next 1.5 hours, plus, in fact, the recording of this webinar will be on the kortenconsulting.com website, which is my consulting company in Mauritius's website, where you or colleagues or friends are welcome to view it again. Okay, so we'll talk about Mauritian residency options, working and or residing. I need to explain some Mauritian income tax definitions. I am aware that a lot of you are not tax professionals or accountants or lawyers or financial people and may not be well acquainted with how tax rules work and how tax laws operate. So I'll be as layman as I can and try and explain it as simple terms as possible and really just alert you to certain issues which you may not need to understand in detail but be aware of so that you know if and when you need to obtain further specific individual advice on your specific circumstances that may affect and be required in order for you to make a decision about moving to Mauritius. We'll go through individual taxation. That's changed a lot recently. It's actually the personal tax rates, if you're a high income earner in Mauritius, are actually very high. They're almost higher than South Africa. So it's very important to understand that. Fortunately, if you have your own business and you're not just restricted to being a high paid employee, there are ways in which we can structure your affairs such that your personal individual taxation can be brought down considerably to what would otherwise be a very punitive rates, and I'll explain that later. I'll explain how Mauritian company taxation works. The chances are, if you move to Mauritius and you start your own business, or you consult back, or you provide services or certain activities from Mauritius for the benefit of your South African business, if you still have it, you're going to do so through a Mauritian company, and need to explain to you how that works. There are various Mauritian tax holiday programs, not really exemptions, but a period of tax holiday, generally 5 to 8 years. They're worth noting, and I'll take you through them quickly to see if those could be applicable to you, which would make Mauritius all the more advantageous or beneficial for you to consider. I need to touch on forced heirship rules. We have freedom of testation in South Africa. In other words, when you die, in your will, you can dictate who receives your deceased estate. You can leave it to your spouse, you can leave it to one kid, to whoever you wish to. Mauritius doesn't work on that sort of system. You are obliged to leave your estate in a certain fashion, and it's important to understand that, because if you become Mauritian domiciled, that is what you're subject to, and there may need to be certain planning to deal with that if it doesn't suit you. The blacklisting issue, you may or may not be aware, but Mauritius has received some negative press in the recent past in terms of the European Union having put Mauritius on a blacklisting list. I need to explain that to you. I don't want to skirt around it. I don't believe it's a big issue at the end of the day, but it's important to get it out there and to explain it and put it into context. Then personal perspective, living in Mauritius. I'll try and spend a bit of time on that, just giving you my personal views and the views of a lot of South Africans that I've seen who are living in Mauritius or have lived in Mauritius, looking at the good and the not so good. And depending on your specific preferences and what's important to you and what's not, that may be important for you to understand on a personal level, whether it's going to be a place that you're going to feel happy and content and productive and have a good life if you were to move to Mauritius. So I'll try and do all of that in the next 1.5 hours. So let's start with Mauritian residency options. It's really, they were recently amended to make them more accessible, and really Mauritius does have some very good programs and options for you to come and live and work in Mauritius, which are not really punitive at all compared to other countries, bearing in mind that you don't have a Mauritian passport, so you need to find other ways to have residency in the country, and also bear in mind that for all intents and purposes, you're unlikely to ever get a Mauritian passport. And that, from a long-term perspective, is something for you to be mindful of in determining whether these residency programs are good enough for you to consider Mauritius to be your home for a sustainable period. There's a website, www.edbmauritius.org. It's a very good website. Everything that I'm explaining to you to do with Mauritian residency options is on that website. So you'll be able to get more detail than what I'm giving you on these various ways in which to get residency in Mauritius. Please have a look at that. The first way, and generally I found for most of my clients, the best way for a South African who has his or her own business is moving to Mauritius to either expand that business internationally or to continue to run it from Mauritius or to rebirth it in Mauritius, having terminated the South African business. If you are working and you need to work and you have your own business or you're a partner in a business, the investor occupation permit is generally the way to go. It's initially a 3-year permit. You need to show that you're a major shareholder, not necessarily the majority, but a major shareholder and director of a Mauritian company, whether it's a domestic Mauritian company or what we call a global business company, a GBC. I'll explain to you those distinctions shortly. It could be either of those two, but it does involve you setting up a business in Mauritius, investing into that business. And the way in which you do that is you'd either put a cash investment of $50,000 minimum. Previously, it was $100,000. From about September this year, it was reduced to $50,000. So that's far more accessible to many of us. And bearing in mind, you may not need in the business, for example, if you have a consultancy-based business or a business where you can generate revenue very quickly after establishing it, you don't need major capital in the business. Needs to say, just understand, putting that $50,000, it's not a fee. You're not paying that to the government. It's not something that you're paying in order to buy your 3 years of residency. You just have to bring it into Mauritius, invest it into your own business. You can take it straight back out again a year later if it's no longer necessary. But it's a show of commitment, and at the end of the day, it needn't be a cost at all. Alternatives are to acquire an existing Mauritian company that has a net asset value of $50,000 and 12 million rupees turnover in the previous 3 years. RS is rupees, it's not rands. It's 2.5 rupee to the rand if you just want to convert back to rands to get an idea. The alternative is $25,000 of cash and $25,000 of imported value of high technology machinery and equipment. So those are your that's your investor occupation permit initially for a 3-year period. You can renew it for a period of 3 years by showing at least 4 million rupees of turnover in year 3. At the time of your application for renewal, you will likely get the 3-year permit renewed. You also have an opportunity in the course of that renewal to rather go for a 20-year permanent residency permit. And I'll come and explain that to you in a moment, and that's generally a better way to go if you meet the criteria. Then you have your so-called professional occupation permit for 3 years. It's a misnomer. It's not professional because it's not requiring a professional qualification. It's really meaning an employee permit. That's where you're going to be sponsored as an employee of a Mauritian company. So you're an employee of a Mauritian company. You're not a shareholder as such. And you're going to obviously have a salary with a 3-year permanent employee status to work in Mauritius, and you'll need to have a salary of at least 60,000 rupees a month for that 3-year period in most industries. That's not even 25,000 Rand a month. It's not particularly high. For certain industries, information communication technology, business process outsourcing, pharmaceutical manufacturing and food processing, those are particular sectors where Mauritius is trying to encourage skills into the country. So if you're employed in those sectors by a Mauritian employer, your minimum salary need only be 30,000 rupees a month. I mean, that's not even 12,000 Rand a month. Certainly, you wouldn't be able to live on that in Mauritius, as I'll explain to you. But later, the cost of living in Mauritius is materially higher than South Africa. And while your taxes, depending on your situation, might be less and should be less if structured correctly, just understand that the cost of living is high. And we'll go through that later. Then you have a retired non-citizen residency permit for 10 years. So as a South African, if you want to retire in Mauritius, you don't need to work, okay? You don't need to generate a living by providing services or running your own practice or whatever the case may be. Then you can. This is the easiest way to get the right to live in Mauritius but not to work. Okay, so it doesn't mean you can't dabble with your offshore portfolio or to, while you're traveling, going and doing a bit of consultancy work, but from Mauritius, you can't be working, whether it's for a Mauritian or non-Mauritian clients or employer. You need to be over the age of 50 years, and you need to transfer the initial sum of $1,500 to Mauritius, and then $1,500 a month, or in aggregate, $18,000 per year. That's not onerous, and certainly you won't be able to live off that. So that's definitely one to consider if you are already a net worth individual. Your money will probably be largely placed in an offshore structure that's appropriate, and you will draw into Mauritius what you need as and when you need to in order to live. But you will become a Mauritian tax resident by definition, so bear in mind we have to still have tax planning issues in terms of what you bring into Mauritius. You then have the self-employed occupation permit. That's really your professional permit, as the English language would dictate, because This is for professional people, for accountants, architects, lawyers, this, that, and the other. It's a 3-year permit. You'd have to do so as a sole proprietor, have a professional qualification, initial transfer of $35,000. In your renewal for another 3 years, you'd need to show minimum turnover of 800,000 rupees in the 3rd year. I've never really done one of those. Quite frankly, the difference between $35,000 and $50,000, you definitely want to rather use a company as a vehicle through which you conduct your profession, ideally, unless your profession doesn't permit you to use a company to do so, if you're, for example, a doctor. I generally don't, and for tax planning purposes, you do want to work through a company where the tax rates are significantly lower than individual tax rates. There's a significant arbitrage between the company tax rate and individual tax rate. As I'll explain to you later, effective taxes on individuals go up to 49%, whereas company taxes don't get higher than 50%. We also have a residency by residential property investment. That's probably the best publicized and best known. You may be aware there's been a big trend in Mauritius to, sugarcane has been the mainstay of the economy for many years, and most of the land mass is covered in sugarcane, and to a large extent still is. But the sugarcane property owners are trying to convert that land into developed property of one description or another, including residential property. And there are these designated residential property schemes that are available for foreigners to buy. As I'll mention a bit later, unfortunately, unlike a country like South Africa, where a foreigner can buy any property he or she wishes, Mauritius has restrictions on the ownership, particularly of residential property, by non-citizens of Mauritius. So as a South African coming into Mauritius, and I'll touch on it later, don't ever expect to get a Mauritian passport. It's highly unlikely that you ever will. You are going to have this problem where you can't just own whatever home you want to own. You need to own a home that foreigners are entitled to own. They fetch a big premium to properties that are only available to locals. So it's not value for money as far as I'm concerned. But again, that's part of the deal. You come here if you wish to. It's certainly not a mandatory thing to do. Yes, I understand if you are, worried about South Africa, but you don't want to leave South Africa yet, but you want to have a so-called plan B, where at any point in the future, you're going to be able to pick up your family and leave South Africa if things become untenable in South Africa for your purposes, and you don't have another passport, and you're looking for a residency program. You get them all over the world. England are developing them. We've got the well-known Portuguese residency programs. Malta has one. There are various countries that have residency programs all around the world. Whether you want to live in those countries or not is another story. That's a different program, a different issue. In Mauritius, to live in Mauritius is not actually, you don't need to buy a property. I've gone through with you the other different programs that there are in order to not only live, but to work as well, where you don't need to go and buy a $350,000 property. Here, they've changed the rules and they dropped. Previously, there was a minimum of $500,000 that you would need to spend on a property. I can tell you, you're not going to get much for $500,000. You're going to get a very small 150 square meter high density flat in some type of a development. That you're going to struggle to fit your whole family into. So really, if you're looking for what you may have been accustomed to in South Africa, a so-called villa or a sort of 400, 500 square meter house with 3 bedrooms, we're talking millions. We're talking a couple of $1 million. But at least those properties, in the absence of a COVID type environment where obviously everything has reduced in value, which does make the question, might be a good time to look at buying. You at least have an international market to sell your property to. So generally, these properties have been reasonable dollar hedge investments for those who bought in sensibly in the right developments at the right time. But definitely an option, not necessarily the first thing that you have to do. Rather come and have a look-see and come in on what's called a 1-year premium visa, which I'm coming to, and then look around. And then if you want to buy a property, for your plan B, exit strategy from South Africa if ever needed, then absolutely that's something to consider. It gives you the right to live and work in Mauritius for as long as you own the property. And you do have the ability to structure ownership of the property through a company or a trust. We'll touch on that a bit more later because there are some tax complications. Why would you want to put it through a company or trust? Well, you may be wanting to save on or trying to shelter South African taxation because you haven't terminated South African tax residency and you'll be earning income on the property, or maybe you're going to sell the property before you leave South Africa, all sorts of options. But then there's also tax issues in Mauritius in terms of the revenue you generate from that property. If it's not in your name or it's a company, particularly if you're living in that property, there are some complications that you need to be mindful of if it's in a company or trust. Just note that this permit, as much as it gives you the right to be in Mauritius for as long as you have that property, it is only the applicant, the main applicant, whether it's the husband or the wife or whoever you choose is going to be getting that permit. It's only that person that has the right to work in Mauritius. Spouses and anybody else that are dependents under the person that applies for that permit are not entitled to work in Mauritius. You then have a permanent residency permit for 20 years. That's a meaningful permit. You don't get that first off. You need to get it on the back of firstly going for one of the other permits that I've already discussed. And after the 3-year period of those permits, when you want to renew, you have the choice of rather upgrading and going for the 20-year permits, provided you qualify. So if you spent your 3 years on your professional permit, that's the employee permit, and you've shown a minimum of 150,000 rupees a month of taxable salary during those 3 years, then you have the right to the 20-year permit. And that's definitely something to consider. To be honest, 150,000 rupees, you're not going to be able to live on that in Mauritius if you are the breadwinner and you've got a spouse and dependents and kids at school. That's definitely one to consider. The other one, which usually I find more applicable to my client base, is the investor occupation permit. You've come here, you've started a company, you've started a business from Mauritius. After 3 years, provided that you show that that company that you started here has a 15 million aggregate of profit in the last 3 years, 50 million rupees, or 45 million of turnover for any of the previous consecutive 3 years. In other words, it's been a successful business, you've done pretty well, then you are entitled to get the 20-year permanent residency permit. For the self-employed, the requirements are quite a lot less and it does beg the question to maybe use that self-employed permit if your long-term strategy is to have security of tenure, and 20 years plus 3 is a good whack of time to have security of being able to live and work in the country. You show your, you just need to show 3 million turnover in aggregate during the 3 years. So average of 1 million a year, and you get your permit. You may have hardly made any profit, but you'll get your permit. After 3 years under the 10-year retiree permits, if you've shown your 18,000 a year, which is your 54,000 for the 3 years, if you've shown that having come into to Mauritius, you'll be entitled to upgrade it to a 20-year permit. Carry on with those residency options. It's important to note your dependents. So that's not those permits that I've mentioned is not a permit for the entire family. It's a permit for one individual. And then the dependents get the right to live but not work in Mauritius on the back of the primary permit holder. So the spouse, including common law spouse of the opposite sex, so Mauritius, a conservative country, the laws do not recognize same-sex marriages or unions of any nature. They can live in Mauritius, and as can the parents-in-law, and children under the age of 24. So provided your children include stepchildren, adopted children, if they're under the age of 24, they can live in Mauritius, okay? If they're over the age of 24, they can't. They'll need to have their 3-year travel visa to come here, or they need to go and get an occupation permit. There is a study permit if you're studying at a Mauritian university, which may or may not be the case. I haven't included that here, but for the most part, you just need to be mindful of kids that are in their 20s, that there's that issue that develops. Now, very recently, I think it was the 23rd of October, the Mauritian government announced a premium travel visa. Okay, now the premium travel visa, I think, has really been designed to fit in with these COVID times that we're living in, and I would imagine that the year 2021 is not going to be a lot different to 2020. Certainly not for the first half of the year, and who knows how things will go. We have a quarantine system in Mauritius, as you're aware. We are technically COVID-free, but part of why we are able to do that is that whenever any person comes into Mauritius from outside of Mauritius, there's a mandatory 14-day quarantine period. It's no self-quarantine like in South Africa or elsewhere. You go into a facility. Generally what they've done is the hotels have made themselves available, and you have to pay for your quarantine, and you can go 3-star, 4-star, 5-star, and you and whoever are with you are stuck in that room or apartment or whatever it is. You cannot socialize, you cannot see other people, you cannot move out of that hotel environment, you can't even walk on the beach. That's your 2 weeks quarantine, and you get tested every few days, and if you're clean after that period, you now can move into Mauritius and have free travel around Mauritius. So if you're coming for a holiday, or you're looking to come and have a look-see to determine whether Mauritius is the place for you, and you're wanting to look at properties, you're wanting to look at businesses, you're looking at service providers, the various issues that you need to look at to consider Mauritius schooling possibly, you can't do that at the moment. So what they've announced is that you can get a 12-month visa to stay in Mauritius. There are a few conditions to that. You cannot enter the Mauritian job market, so you can't go and apply for employment in Mauritius or really generate business with the Mauritian market as such. What you can do is you can work in Mauritius when you're here, as long as your main place of business and the source of your income, source meaning not where you do the work, but who's paying you for the work, who your customers are, who your clients are. If that is predominantly outside of Mauritius, that's fine. So you can continue to draw a salary and manage your business back in South Africa, or do whatever it is that you do for your clients around the world or in South Africa from Mauritius, and invoice them accordingly. The taxation issues are another story, but you're not prohibited from working in Mauritius on that basis under that 12-month visa. You need to show travel and health insurance, accommodation, and some other basic immigration requirements. There will be an online e-visa mechanism that's to be published shortly. I think it very shortly will be up and running, if it's not already so. Just one thing to bear in mind is Mauritian tax exposure that arises from spending too much time in Mauritius. I will explain shortly what it means to be a Mauritian tax resident as an individual. Effectively, if you're here for more than 183 days in the tax year starts 1 July, then you become tax resident in Mauritius. Even if you're not tax resident in Mauritius, if you generate Mauritian sourced income, and if you're providing services in and from Mauritius, your skill, effort, labor is exerted in Mauritius, even though you're paid by a foreign client or customer, a foreign employer, and you don't even bring the money into Mauritius, it's Mauritian sourced, and you're actually subject to tax on that in Mauritius in the absence of a double tax treaty. So you just need to get a little bit of tax advice that if you are earning income while you're in Mauritius during that 12-month stay, do you have Mauritian tax obligations? The chances are unlikely as a South African, because you are unlikely to have terminated South African tax residency. By not being in South Africa for 183 days does not mean you're no longer tax resident in South Africa. You're still subject to tax on your worldwide income. But the double tax treaty between Mauritius and South Africa will likely absolve you from any responsibility for paying tax in Mauritius, and you'll only pay tax in South Africa. Okay, so I'm already going into the taxes, I tend to. Hopefully you understand these residency options. They're really quite accessible. It's for most people, it's very possible to be able to come and get a residency permit, so to speak, to spend 3 years or 10 years and eventually 20 years living in Mauritius, working in Mauritius. You don't have to buy that property. I'm not saying don't buy a property. I'm saying that's not necessarily the starting point. Come here, look around, look at properties, work out where on the island you want to live, really get a good feel of things, do your research, and then you can make a decision. Okay, so now let's go into tax. Obviously, one of the reasons you'd consider Mauritius, other than its close proximity to South Africa, would be the fact that your tax rate in Mauritius is meant to be quite low. And that's not necessarily the case anymore, unfortunately, but I will explain that if you are able to structure your affairs how you wish, on the basis that you are self-employed or you have your own business, and you therefore have opportunities to structure the way in which you draw revenue out of your business, whether it's in the form of salary or dividends or distributions from trusts and things like that, which we'll come to, then the Mauritian tax laws that have become quite high for individuals need not apply that much to you, and your tax rate will definitely be fairly significantly lower than what the tax rates are in South Africa. But you need to ensure that you structure your affairs carefully. The tax authority in Mauritius is called the Mauritian Revenue Authority, the MRA. The www.mra.mu is a good website to look at all of the tax laws of Mauritius if you wish to. I am trying to be appreciative of the fact that many of you who have joined this webinar are not tax professionals or accountants or lawyers or people that are well acquainted with tax law and those sort of concepts. I'll try and be as layman as possible, but I think it is important for you to at least get a feel for a lot of these things. Please also bear in mind that this webinar, I'm not sure if I mentioned it earlier, this webinar will be, is being recorded and will be posted on the kortenconsulting.com website, as will the PowerPoint notes. So you'll be able to have a refresher and also refer your advisors or your friends or family members to go and look at this webinar or watch this webinar through the website. Now, in South Africa, a lot of you will probably be familiar with the concept of the family trust that's been used in the earlier days, some 10, 15 years ago, for tax planning purposes, but more for estate planning, estate duty planning, asset protection purposes. Those of you who have got relatively high net worths, trusts can play a role and a strong role. Now in South Africa, trusts, they've really been beaten up. The tax laws have made it very difficult for trusts to really be of any great benefit, certainly not from a tax planning perspective, and difficult from even a estate duty planning perspective long term because of the way in which the laws are now framed. Mauritius, the laws are very simple. In fact, a trust is considered a company. And it's better than a company because the beneficiaries are effectively considered the shareholders, and you may make a distribution to one beneficiary, not to others, and that's considered a dividend to that beneficiary. So distributions from a trust are considered dividends from a company. And local dividends are not subject to normal income tax. There's another tax that may apply to it, but normal income tax, your 15% normal income tax doesn't apply to local dividends. It's tax-free. So that it's important to understand why I'm bringing it into play is that if you're going to start your own business in Mauritius, generate revenue, go the investor permit route, which I think a lot of you will tend to do if you do come here, you're going to want a trust, whether it's a Mauritian trust, a so-called local trust, or an offshore trust, which will be a trust somewhere else in the world. It's going to be part of the structuring, and your shares in your Mauritian company, you're going to want held in that trust. Okay, another important definition is the whole concept of export of goods. Again, another misnomer. You're not really exporting anything from Mauritius. What you're doing is you're buying goods outside of Mauritius and you're selling them outside of Mauritius, so they never come into Mauritius. So you're buying and selling tangibles. It's going to be tangibles as principal. So it's not an agency. It's not a case that you're getting revenue as a distribution agent. You must be actually buying and reselling as principal. And if you do that outside of Mauritius, but from Mauritius, in other words, the goods never come into Mauritius, then it falls within that definition of export of goods. And if you generate profit in a company through export of goods, that profit is only subject to a 3% tax rate. And that's a very favorable tax rate because most other types of income that a company generates is subject to a 15% tax rate. Okay, your year of assessment, your tax year ends on 30 June. In South Africa, it's 1 March to 28 February. In Mauritius, it's 1 July to 30 June. For a company, it can be any 12-month period. A couple more definitions, the whole idea of deriving of income, derivation of income. So there's a concept of Mauritian sourced income and foreign sourced income. The concept of source is pretty much the same as the South African concept of source. And for those of you who understand, it doesn't necessarily mean where the money is paid from or who pays it to you. It's where is the main reason, or what they call the dominant cause, that gives rise to that income arising. So if you've got an offshore portfolio of investments, or you've got a property in the UK deriving rental income, obviously it's not locally sourced. It's sourced in that country because that's where the activity is taking place. But if you're providing services from within Mauritius, you're exerting your skill, effort, and labor in Mauritius in order to derive the income, then even though your customer or your employer or your client may be outside of Mauritius and may pay you outside of Mauritius, and you may not want to bring it into Mauritius, it's still Mauritian sourced. And the rule is that whether or not you're a Mauritian resident, if you generate Mauritian sourced income, it's subject to tax in Mauritius on that. Okay, it's the same as South Africa for non-residents. You will obviously become a Mauritian resident, so that's of less applicability to you. Foreign sourced income is taxable in Mauritius for Mauritian tax resident juristic entities. So if you have a Mauritian trust or a Mauritian company, it's a worldwide residency-based system of taxation. You generate from a Mauritian source or a foreign source, it's taxed in Mauritius. Okay, the rates may vary, and we'll go through that in detail, but it's taxed because however, for individuals, it's funny, it's a bit different. So for Mauritian tax resident natural persons, if you move to Mauritius, you'll become a Mauritian tax resident person as an individual. Your foreign sourced income is not taxable in Mauritius unless you bring it into Mauritius or you apply it in Mauritius. So it's only taxed in Mauritius when, and to the extent that you remit it back into Mauritius, into a Mauritian bank account, or you apply it in Mauritius for your benefit. So if you've got a foreign credit card and you spend it at shops in Mauritius, you are effectively bringing it back to Mauritius and you trigger the tax if that was foreign sourced income in a previous year when you were a Mauritian tax resident. So it delays the tax indefinitely until you actually bring it into Mauritius. So, tax planning is very important for a South African expat coming to Mauritius who wasn't a resident, now becomes a resident, has assets and income that was generated before becoming a resident. That needs to be sort of quarantined in a different place so that you can bring that in and show the MRA that no, that was pre-residency income and capital, it's not taxable, as opposed to post-residency income, which you're not going to want to bring in, otherwise you're going to pay tax. Let's talk about individual taxation now. So now individual taxation, as I said to you, it's gone up significantly since about effective September this year. Since the July budget, they've effectively increased the taxes on individuals on the basis that I'll explain to you now. Before we look at the rates, let's look at the definition of being a resident. So if you're domiciled in Mauritius, and sure, if you're a citizen, you're domiciled in Mauritius, unless you live somewhere else. But if you have your occupation permanent and you make Mauritius your home, and this is where you predominantly stay, I would say by year 2, you become domiciled in Mauritius. But the other way in which you become tax residents in Mauritius is that you spend sufficient time in Mauritius. So if you spend 183 days or more in the tax year, so it'll really be applicable to most of you for 1 July 2021 onwards, then in that tax year, if you spend 183 days, you become tax resident from the beginning of that tax year, from 1 July 21. Or if you spend 270 days or more in 3 consecutive years, then you become residents in the beginning of the year when the 270 days occurs. This is quite handy and useful in the context that you become a Mauritian tax resident and you want to retain that Mauritian residency because for compliance and worldwide purposes, you don't want to be considered tax resident anywhere else, but you don't spend as much time in Mauritius anymore. And that really, what happens if you in the first year spend 183 days, you become Mauritian tax resident from the beginning of that tax year. Then afterwards, you don't have to spend 183 days in Mauritius. You just need to spend, in aggregate, not at least 90, 91 days a year to maintain your Mauritian tax residency. That doesn't mean you can now spend, 250 days in Mauritius, in South Africa, being living there, and say, no, I'm not tax resident in Mauritius, in South Africa anymore. That's another issue altogether. And the rule generally is don't spend more in aggregate than half your year in South Africa. So you can spend half your time in South Africa, half your time here, and be tax resident in Mauritius only. Okay. There's a bit more to it than that, and that falls outside the scope of what I'm going through today, because I won't have time to go through that. But those are all planning issues, because I've dealt with a lot of South Africans who've looked at coming to Mauritius, but they don't necessarily want to spend that much time here. And they've still got a business in South Africa, and they've still got family there, and the kids are at university there, and this, that, and the next thing. So how do they manage their time so that they have Mauritian tax residency, which is more beneficial than having South African tax residency, and ensure that they terminate their South African tax residency and don't re-establish South African tax residency. So those are issues to consider at that time. Let's just stick to Mauritian tax. So as an individual, depending on your number of dependents, your first 325 to 680,000 rupees. So if you've got 4 dependents, then your first 680,000, you've got no dependents, then your first 325,000 is not subject to any tax. Okay. Then for the next 650,000 over and above that exempt threshold that applies to you, there's a 10% tax rate that applies. Then anything in excess of that, your personal income tax rate is 15%. Now, it's publicized, and I've seen a lot of articles, even in South African tax publications, saying your South African tax rate is 15%. It's not. It's much higher. And I'll explain to you in a moment why it's much higher. And they call it different names, but it's effectively another tax. So bear in mind that that 15% tax rate, which is a very reasonable, very, very fair tax rate, that's all fine and well, but unfortunately, there's more to it than that. And this is what you really need to know. And a lot of that really became applicable as from September this year, based on the Mauritian budget, where they've really jacked up the rates of tax on individuals. So there's no tax on foreign source income that is not remitted or applied in Mauritius. But remember, if you're rendering services from Mauritius, the source is in Mauritius. Doesn't matter where you get paid and who pays you. Now, here's where the bad news starts. Okay, the bad news is that from 1 September 2020, there's this thing called an individual solidarity levy. It's just another tax, okay, on individuals. Doesn't apply to trusts, doesn't apply to companies, applies to individuals. Okay, it used to be a 5% tax, okay? It came in a couple of years ago, but as from 1 September, they've jacked it up to 25%, okay, on leviable income. Now, sorry, with my camera in the way, I can see it's blocking some of the writing. It says leviable income. Leviable income is your taxable income plus your tax-free local dividend. So as I've said, dividends from a local trust or distributions from a local trust and dividends from a local company are not subject to income tax, but they are subject to the individual solidarity levy if, when you add up your dividends plus your taxable income, if that exceeds 3.5 million rupees, okay, up to 5 million rupees, effectively, you have a 25% solidarity levy tax. So in that bracket of 3 million to 5 million of taxable income, inclusive of local dividends, you're getting whacked at 25% plus 15%. And I'll show you another 9% on top of that. Okay, after 5 million, your ISL drops to 10%. What they say is that your ISL cannot exceed more than 10% of your total taxable income from the beginning. But remember, for your first 3 million, you don't pay ISL. So ISL only kicks in on the portion of your taxable income plus dividends that exceeds 3 million. Okay, so the key is keep your taxable income under 3 million. And that seems like a lot of money, but I can tell you if the cost of living in Mauritius is at least 50 to 100% higher than South Africa, particularly if we're talking about private schools or sending your kids to boarding schools overseas, if if schooling options in Mauritius are not suitable to you. We'll talk about that later. Holidays means the whole family traveling internationally. That's not cheap. Okay, it's not like South Africa. You can just go from one province to another, and it's really a holiday. It's a different place. Mauritius is a small little place. You're going to want to get off the island once or twice a year and have a family holiday. You'll obviously be traveling to and from South Africa potentially if you still have ties there. And again, depending on your lifestyle, what your commitments are, your dependents, whether you have children that you still are paying for, various things will impact how much disposable income you need in order to live a good way, and in a good way, not extravagantly, but live like you lived in South Africa. 3 million rupees is it's going to be close. It's not going to be you're going to struggle with that. To be honest with you, sure, if you're single or if your kids are grown up and you paid for everything cash, you've got capital, your means are quite modest, then 3 million is more than enough in order to live well in Mauritius. But you want to keep your income under 3 million, and you're going to be exposed to effectively a 24% tax rate. Okay, I'll come to explain why in a moment. But if it goes above 3 million, sure, it goes up astronomically. And that's why it becomes very important for you to plan your affairs. The next bit of bad news, as from 1 September 2020, they've changed the rules and they've introduced what's called a contribution sociale généralisée. Okay, I don't speak French. Basically, it's general social security contributions. Basically, compulsory pension fund contribution. Before, it was limited to effectively 6%, and it was capped at 50,000 rupees. Okay, and then it didn't apply. So it was really a minor thing. Now, the capping has fallen away and they've jacked it up. If you earn more than 50,000 rupees a month, which you will, okay? You're earning more than 50,000 rupees a month, it's 9% compulsory contribution to the CSG. In theory, 3% by employee and 6% by employer, but we all know we work on a cost to company. If we're going to come and work for an employer in Mauritius, we're looking at our net take-home pay, or they're looking at what is the total cost of employment. And I'm focusing a lot more on entrepreneurs and people that run their own businesses. That's the cost is 9%, okay? And it's not on the portion that exceeds 50,000. If your salary is over 50,000, then it's on everything, okay? And it's just another tax from an expatriate perspective. Because to just give you an indication, to be able to claim, okay, you need to be over 60, you need to have been in Mauritius for 15 years over the age of 40, and then the maximum you'll ever get paid out is 9,000 rupees a month. It's a tax, okay? And you've got to see it in that context, it's another tax. You're never going to get it back. Okay, so let's summarize. You've got on the first 960,000 rupees of salary, you've got a 15.8% effective tax rate. It's about 6.8% income tax, and you've got your 9% SCSG. You then, from 960,000 to 3 million, you effectively have a 24% tax rate on that bracket because you're going to have your 15% income tax and your 9% CSG. Okay. Now, after 3 million, the ISL kicks in and suddenly your tax is a 49 flat rate of tax on income between 3 and 5 million rupees. 15% income tax, 9% CSG, 25% ISL. And then after that, if you're still earning income in excess of that and really you construct your affairs that you don't ever get there, then the ISL comes down. So you're going to pay a 34% tax rate on that portion over 5 million rupees, which is 15% income tax, 9% CSG, and 10% ISL. So you can see here, if you convert this all back to rands, the personal tax rates are really not much different. So if you're coming to Mauritius thinking that your individual taxation rates on salaried income, okay, on personal income is going to drop significantly, you're going to think camping is not, okay, unless you plan your affairs that you do not generate personal income. Okay, and there are ways and means of doing that if you have your own business. So the good news is that between you and family members, we can limit your income to being not more than 1 million rupees a year. Okay, pay a bit of income tax, pay your CSG, receive dividends from your company, but not personally, to a trust. There's no ISL for the trust. The trust, it's tax-free, the dividend income in the trust. The trust then makes distributions to your spouse and to your dependents. For the first 3 million of those distributions each, it's tax-free. So there are definitely ways to plan so that this doesn't happen, at least for the time being. And if the Mauritian authorities start putting anti-avoidance rules in to counter that, well, we'll have to deal with it when the time comes. But certainly not in their interest in terms of encouraging foreigners to come and live and work in Mauritius if they're paying these kind of tax rates. Let's get back to the good news, okay? So the good news is that there are no currency exchange controls, there's no estate duty, there's no donations tax, and there's no capital gains tax. That also gives us opportunities for planning to orchestrate capital gain transactions. It's fun for me as a tax practitioner here, and then it's a lot easier to plan to save people's tax. You still need to, still rules and anti-avoidance rules that we need to stick to and be careful of, but they're definitely, it's a lot easier. The Mauritian tax laws are not particularly sophisticated, and there are ways and means to structure your affairs. Okay, I need to go quickly now because there's a lot more to cover, and we're already almost an hour into the presentation. So you've got a VAT rate of 15%. You've got some anti-avoidance rules, like you can't just, anyway, you wouldn't be able to because they would need a permit in order to do so, but you couldn't just put your spouse who's not qualified on a permit and pay her a salary. That can be a tax, and like it is in South Africa. I mentioned earlier, if you buy an IRS or PDS property in Mauritius and you choose to buy it in the name of a trust or a company, you've got to be careful because there's a deemed rental income in favor of that company if you're living in it. So basically, the company will have a market-related deemed rental income that accrues to it if you are living in the property. Okay, very foreign idea in South Africa. In trusts, it's not really that. In trusts, it would be seen as effectively a dividend that you're getting to the value of the fair market value of a rental income. In other words, you're getting a rent-free benefit. And as long as that rent-free benefit doesn't exceed 3 million rupees a year, there shouldn't be a tax implication. But for companies, there is a tax implication, particularly if your company is not geared, you don't have expenses in the company to counter the taxable rental income or deemed rental income in the company. There's actually a recent MRA tax case that dealt with this, and they're looking now to enforce this rule, which has been in the Income Tax Act for many years, and you're looking to enforce it more stringently. Okay, I mentioned deemed dividends to beneficiaries living in a trust property. There's your general anti-avoidance rules, which requires that, if you're trying to do some tax planning, you've got to make sure there's commerciality, normality, and substance to what you do. I'm not going to go further on that other than to mention that if you receive director's fees, doesn't matter where you provide your services director, there's a 15% withholding tax, pay as you earn at 15%. However, note that non-executive directed fees, there's no CSG. So if you pay yourself a non-executive director's fee, you get a 15% flat tax. You'll probably get a refund end of the year because you didn't pay at the normal rates. But as long as a non-executive director's fee, there's no CSG that applies to that. So tax deducted at source, there are certain withholding taxes. You've got your pay-as-you-earn system like you do in South Africa, but you also have withholding tax obligations on rentals, on contractor payments, to professionals, on commission payments in certain circumstances. I'm just putting it out there. There are obviously detailed rules, and I'm not going to go through them in detail other than to mention that they exist. But it's a withholding of taxes that would otherwise be due. It's not an additional tax. So for individual planning issues, I've mentioned briefly, quarantine your pre-residency capital and income before you become a Mauritian tax resident. Use local or offshore trusts foundations to accrue local dividends that are not taxable in Mauritius, and use income splitting opportunities distributing to non-income earning spouse and children living in Mauritius. Okay, obviously you'll get more specific and detailed advice as to how to do that and where that can work and where that may not be able to work. On a case-by-case basis. Orchestrate market-related capital gain transactions. Capital gain transactions do not attract any tax. And again, you could create a nice loan account for yourself with your trust and have a mechanism to draw tax-free money from your trust at a future point in time. Okay, let's look at Mauritian company taxation. Okay, so South Africa works on the concept of place of effective management. If you're calling the shots from South Africa, it's a South African tax resident company, or if it was incorporated in South Africa. Mauritius works on the concept of central management and control, which is a slightly weaker concept, but for most of you, that's not something I think is that important to you right now. It will be for those of you that want to set up businesses here. Now, before we had what we called a global business license regime, which enjoyed an automatic effective 3% tax rate for GBL1 and a 0% tax rate for GBL2. Now that's gone, okay? There's certain grandfathering for those that existed in 2018, but with EU pressure on Mauritius, it's had to streamline and make its tax system more fair and not discriminate between taxing foreigners and taxing locals. So this 3% effective tax rate on Mauritian companies is not applicable as such, or at least not in the same way. So what we have now is you have your global business company, you have what's called an authorized I'm just mentioning it. Authorized companies are generally pretty useless, and certainly I don't see them having any benefit whatsoever in the context of you as a South African moving to Mauritius and living and working in Mauritius. You wouldn't use that type of company. You'd either use a domestic company for a domestic business or own a local property potentially, or you'd use a GBC either because you're forced to or because it makes sense for you to do so. So why would you use a GBC, a global business company, if more than half of the ultimate owners are not Mauritian citizens and more than half of the revenue is sourced as in comes from, not necessarily where the work's done, but where the market is that is tapped into to generate it is outside Mauritius, then the law requires that you have to use a GBC licensed company. Now, what's the difference between a GBC licensed company and a domestic company? The one is price. Okay, domestic company is a very simple company, no audit requirements, simple licensing requirements. You don't need to use a Mauritian management company and other service providers to act as directors and company secretary and registered office and submit quarterly tax returns to the MRA and all sorts of other filings. It's highly regulated. Compared to a domestic company, also it has an audit requirement, a GBC. I would say you're looking at between $6,000 and $10,000 a year in additional compliance costs for a GBC versus a domestic company. So you say, oh, I want to use a domestic company. The tax rates are the same. There's no difference in how they're taxed. It's just one's highly regulated and protects the offshore industry here, and the one isn't. Okay, so sure, you'd want to use the local one, but if you're generating your revenue outside of Mauritius, which it probably will be, Mauritius is a very small place. It's a very tight market. It's not a market that's easy to get into as a foreigner, and it is not much revenue to generate from the local market. You're going to probably be doing what you do outside Mauritius, but you might be doing something locally, in which case, yes, you can use a domestic company. But the chances are more likely you're going to be requiring a global business company. It's going to cost more. There's one saving grace in that your tax rate is slightly less. Sorry, I said the taxes were the same, not 100% correct. There's a 15% tax rate is your general tax rate that applies to companies. That's your starting point, unless you've got this export of goods, which is a 3% tax rate, and there are a few partial exemption and tax holiday programs, which I'll come to. But they apply to domestic companies and GBCs. The only thing is there's an additional tax called a Corporate Social Responsibility Levy, CSRL, of 2%. That's another tax. So if in fact your domestic company is subject to 2% tax. So at the end of the day, depending how much money your company makes, and if it's a very active, successful company or GBC, it's going to cost $6,000 to $8,000 more a year to run in compliance cost, but you're more than likely at least by year 2 or 3 to be for that to be made up for by the fact that you're not paying the 2% CSRL, which would apply as a domestic company. Okay, so companies pay in general, and sorry, my screen seems to be in the way of the slide, the way I'm seeing my screen. It's a 15% company tax rate, okay? It only pays 15%. unless there's an 80% partial exemption. And Mauritius works, interestingly, on the nature of the income. So depending on the nature of your activity, you may have different tax rates. So you're buying and selling tangibles outside of Mauritius, so-called export of goods, you're paying a 3% tax rate on that type of income, less the expenses associated with it. Okay, but you could qualify for an 80% partial exemption, which is an effective 3% tax rate. Or, okay, I mentioned the 3% rates that we dealt with in the definition, or a tax holiday applies. Okay, so if you're in a particular industry where a tax holiday for a period applies, then you get the benefit of that. So you do need advice to understand what do you want to do in Mauritius, what type of company do you need to use, what sort of tax rate will apply. But unless you're buying, unless it falls into an 80% partial exemption, or a tax holiday where it's a whole process to apply for that tax holiday, you're likely to be paying 15% tax. Bank on, if you're providing services of any nature, any kind of intellectual property related revenue, whether it's licensing fees for software or royalty related, rental of goods or of any nature, it's all 15%. Okay, so let's quickly have a look through those programs. So your 80% partial exemptions, they all require minimum substance of activity and expenditure in Mauritius. Don't worry about that. You're going to be in Mauritius, so you're doing it here. It's more of an issue for those who are trying to run businesses in Mauritius, but they haven't moved to Mauritius. And they don't have staff in Mauritius. That's a problem, and that's a whole nother area of discussion from a taxation perspective. So if you get foreign source dividends, okay, you're going to pay 3% on those foreign source dividends as a Mauritian company, domestic or GBC. Okay, it could be even less. It could be zero if you can show foreign tax credits at the level of the company that paid you the dividends. Interest income, 3% in the hands of a company. If you are a collective investment scheme, a closed-end collective investment manager, administrator, investment manager, or asset manager, as licensed by the Mauritian Financial Services Commission, in other words, you're providing one of those financial services, then your tax rate is 3%. So obviously, Mauritius encouraged a lot of fund management companies, asset managers, investment managers to set up in Mauritius. Shipping and aircraft leasing activities will get a 3% effective rate. Reinsurance and reinsurance broking, leasing and provision of international fiber optic capacity, more issues to do with aviation. They all received that 80% partial exemption. Okay, before I get onto the holidays, I'm going to have a few words about Mauritian tax resident trusts, because you are going to need a Mauritian trust more than likely if you set up a business here as part of your tax planning. Trust is resident in Mauritius, and if it is administered in Mauritius, and the majority of the trustees are Mauritian residents. The settler was resident in Mauritius at the time the deed creating the trust was executed. The trust is a domestic company for tax purposes, so it's going to pay the 15% plus the 2%, and distributions to beneficiaries are local dividends, which are free of income tax, but are potentially subject to the individual solidarity levy. Your exemption programs, okay? So I'm going to list them here quickly. Individual emoluments managing 100 million, holding an asset and or fund manager certificate, 5-year holiday, health services company registered with the BOI, organic farming project, captive insurance activities until 2025, global headquarter administration. These are, if you go onto the appropriate websites, you can look at these programs. Obviously, it will be best to speak to a service provider in Mauritius, such as myself, to be able to explain to you in detail how those programs work and how you need to apply. Global treasury activities, global legal advisory services, overseas family office, an individual investing $25 million into Mauritius, a 5-year tax holiday, fishing activities. This is quite an interesting one, innovation-driven intellectual property developed in Mauritius, 8-year holiday, but understand that whatever that intellectual property is that you develop in Mauritius, the actual development cannot be outsourced out of Mauritius. your techies that do the actual coding and the software and everything is going to be in Mauritius. You can't, it's got to be done in Mauritius 100%. Pharmaceutical products, food processing activities, automotive part manufacturer, certain e-commerce platforms, business peer-to-peer lending activities. I've given you, again, I've done it very quickly. As I said, these slides will be on my website in a few days' time after the webinar. If you want to refresh on that, you can go and have a look at those slides. A quick word on forced airship rules. I did mention to you earlier that once you become a Mauritian, you cannot just simply leave your estate in your will to whoever you wish. Mauritius works on a forced succession jurisdiction. This arises from the French Napoleonic Code and the Succession and Wills Act of, believe it, 1883, where basically the rule is that for your worldwide assets of a Mauritian non-domiciled person and for the Mauritian immovable property of a non-domiciled person. So strictly speaking, if you buy a property in Mauritius but you don't move to Mauritius, this applies to you with respect to who you leave that Mauritian property. And the rule basically is that you cannot disinherit your children. Your children have to get a certain, what we call a reserved portion. So if you have one child, that child has to get 50% of your estate. If you have two children, 66.6. If you have three children or more, 75%. So if you've got three children, your spouse doesn't get more than 25% of your portion of your estate at the time of your death. Okay, and to plan around that, trusts can be helpful, but they have some but limited application. So estate attribution rules apply to donations and asset transfers to trusts or related persons. So you try and avoid this by giving things away to trusts or selling things or sticking things outside your name before your death. There are rules that will attribute it back to your name. I'm not going to go through this in detail because we've only got 20 minutes left, and I really want to discuss living in Mauritius without rushing too much. It's worth noting that you just need to be mindful of that. And if it is an issue for you that you wouldn't necessarily want to leave everything, if you could have a property in Mauritius, you have to leave that property to your, say you've got three kids, they each have to receive it equally in equal shares. It doesn't make sense. Okay, you're not trying to disinherit your kids, but maybe you want your wife, your spouse to have that property. At least during the remainder of her lifetime. It may not be the property she lived in at the time of your death. If it was, then yes, the surviving spouse retains a lifetime use over the family home at the time of death. So I'm just putting it out there, and it may or may not be important to you, but it's worth understanding that there's no freedom of gestation. There's no estate duty in Mauritius, as I mentioned. Nor donations tax, but there's this rule here, and of course the courts are full in Mauritius of families, heirs fighting over the family fortune. So it's a really poor system, but it arises from the French heritage that Mauritius has received. I'm going to touch quickly on the blacklisting. Okay, so now in around May of this year, the European Union suddenly announced that it's putting Mauritius on a high risk list of country alleging strategic deficiencies in its anti-money laundering and counter-terrorism financing framework. So it's not having an issue with Mauritius in terms of a tax jurisdiction or in terms of not having good laws. It's in terms of the enforcement and the monitoring of issues to do with money laundering and counter-terrorism financing. To be honest, I think there's a lot of politics that has motivated why this happened, but it has happened. It is not a tax-related blacklisting. In fact, Mauritius has very strong anti-money laundering legislation and counter-terrorism laws. However, its system for monitoring, enforcement, and sanction have been lacking. The EU have been asking Mauritius to improve that. The Mauritian government has been slow to do that, but instead of giving them a warning, they just slapped this blacklisting on Mauritius, which is really unfortunate, but it's not fatal. It's not. I don't believe it's a big issue for most people. Mauritius is obviously taking it extremely seriously. It's very actively putting measures in place. In I think September of this year, there was another assessment by the EU to see how Mauritius is doing in removing the 5 areas technical areas that it's finding Mauritius to be lacking in terms of how it enforces and monitors. And Mauritius is doing everything in its power to make sure that it is gets back to where it's supposed to be. And we are hopeful that within the first half of 2021, it'll be removed from that blacklist. But in the meantime, what does it mean? It affects certain banking transactions and investments, particularly with EU funds and EU investors, which would not be able to flow through the Mauritian banking system or through a Mauritian company. So if you're looking to come in early January and set up a GBC and you are going to be investing into the EU or getting EU funding to do this or that, Mauritius is going to be a problem, unfortunately. Okay, that's not to mean that you can't move to Mauritius, but we wouldn't be able to use a Mauritian company, and it will obviously you need to get appropriate advice. It also means that any Mauritian company or company that has a Mauritian bank account, there's enhanced due diligence around the world that applies with first world countries in transacting with those Mauritian companies. I haven't found that this blacklisting has really affected my clients. I've had one situation where I have a client that sends money to and from Australia. That's had to stop because Australian banks won't accept money from or send money to a bank in Mauritius at the moment. Hasn't affected South Africa at all, hasn't affected Africa at all, hasn't affected Asia at all. So I believe that this blacklisting will be a thing of the past in 6 to 9 months' time. And I do believe that it didn't really need to get to where it was. It was partly a politically motivated thing as to why it happened. I won't go into the detail, but I am putting it out there. It is there. I don't think it's fatal to Mauritius. It's not been a good thing, but I don't think it's fatal to Mauritius, and it doesn't change or in any way tarnish what Mauritius is in terms of being a law-compliant country with good laws and generally good enforcement of those laws. Okay, so we've got 20 minutes left. Hopefully I've dealt with some of the issues. I think a lot of you may be interested in this side of it because I haven't seen too many webinars talking about, what's it like to live in Mauritius. And this is not really a professional, this is a personal perspective. So I'm giving you my personal view. It may or may not accord with the views of other people, other South African Mauritius. I'll also share with you the views of a lot of my mates, friends, colleagues who are South African or used to be here as South Africans living in Mauritius and their experiences of Mauritius. And, generally the experience has been very positive, but, you can't always satisfy everybody, and Mauritius is not necessarily for everybody. So before you make this massive step to, sell up and move to Mauritius, you do need to have a good look-see, and you do need to ask around and see, what's it like living in, living in Mauritius. The working will be very much a personal thing in terms of what your business can do, and the chances are Mauritius will be a great location from which to launch those businesses, particularly if you need close proximity to sub-Saharan Africa, to South Africa, to Asia. It's in a great location. Okay, the ease of doing businesses in Mauritius is great. Getting things done, it works, not necessarily lightning speed, but it's certainly a lot faster than things happen in South Africa. And the laws are good. They're not really discriminatory like a lot of the laws in South Africa are tending to become. So let's just look, and this is my personal perspective. So, it's not going to necessarily be yours. It's not necessarily going to be the same as somebody else that you may talk to who's been in Mauritius for many years. This is just my view. The benefits, okay, law, order, and safety. And it's we're being comparative here to say, not to Canada, we're being comparative to South Africa. If we compare living in South Africa to living in Mauritius, it's a no-brainer. It's a safe country. South Africa is not a safe country. It's a safe country. You got a policeman on every corner. The policemen have a strong reputation of, generally speaking, being well respected and, quite frankly, feared by the local community. They police properly. If there's a crime, it's properly investigated. It's the enforcement work. The system works in terms of prosecuting crimes, bringing people to trial, and putting them in prison. So the South African system doesn't work. Okay, so law, order, safety. I've got two daughters. I mean, they're now 14 and 16. From the age of 10, 12, they were taking the bus from home and going to the shopping center for the day. You wouldn't dream of doing that in South Africa. You wouldn't dream of doing that in South Africa. Here, I'm no hassle. I can send my 10-year-old kids to run around the shopping center, and I know they're going to be safe. It's not going to be a problem. That's my view, my perspective. I travel to South Africa often, not this last year, before, in order to consult with clients. My client base is still predominantly South African. In fact, I was locked down in South Africa, April, May, June. During the lockdown, my wife and children are safe. I know, we leave the keys in the car, in the garage, at home. Okay, because we're in Mauritius. I'm not saying that car theft doesn't happen, but it's almost non-existent because where can you take the car? So for the most part, you don't have violent crime in Mauritius. There's no guns. Yes, there are crimes of passion. There are crimes that occur, a lot of petty theft, things like that, but you don't have violent crime. You don't have guns. There are no guns in Mauritius to speak of. It's not that kind of crime. It does happen from time to time. Some loony kills a tourist. It can happen. It does happen, but it's an exception. Okay, things work, sometimes slowly. Okay, something wrong with the power. I call the Central Electricity Board, and within hours, they're there to fix it. Okay, something wrong with the water. There's no load shedding in Mauritius. Yes, the electricity does go out from time to time, 5 minutes, half an hour, it's back. Or they may say to you, we're repairing this tomorrow on Sunday from the time of X to Y, there will be no electricity in this particular area. But there's no load shedding as we know it in like it is in South Africa. Utilities work. Roads get built. I've been here for 12 years. We've got more and more highways. We've got more and more shopping centers. There's more and more retail. It's going forward. It's not going backwards. Okay? Sometimes it's 2 steps forwards, 1 step backwards, but it's going forwards more than it's going backwards. So that is a pleasure. Okay? I'm not saying that Mauritius has got a fantastic level of service or it's a service committed country. It's not at all. It's actually not great at all. But once you find the right service provider and you beg them to come, they come and they sort you out. And from a government perspective, whether it's getting a new driver's license or sorting out this permit or that permit or the next thing, it works. You want to form a company, within a month the company's formed, sometimes a couple of weeks. So ease of doing business from that point of view. From a personal point of view, things work and utilities work. Another important thing is you have a very supportive expatriate community. So as South Africa, there are a lot of South Africans here, predominantly in the north of the island, around the Grand Bay area, and the west of the island, around the Black River area. That tends to be the 2 hotspots for expatriates in general. Your POMs, your French, your Germans, and your South Africans. There are other areas of the island that people stay, but I'm saying that's the 2 sort of more likely spots. And there are expatriate community networks online, otherwise very helpful. When my daughter, after 4 or 5 years of living in Mauritius, my daughter was involved in a very serious accident. The kind of support we got from people that we didn't know for that long is better than I would have ever got in 40 years living in South Africa. The people are supportive. It's not to say that you should stick to the expatriate community and you should stick to the South Africans. And unfortunately, one of the gripes I have personally is the South Africans tend to stick to each other a bit too much instead of trying to make Mauritius their home and adventure out and make friends with other cultures, whether it's the local population or expatriates from other communities. But you come into a new country, you will very quickly find support. You'll very quickly make friends. Your spouses, the wives, very quickly will find support from the schooling on this, that, whether it's the yoga or the Pilates or the gym or the this club or that club. You'll start building a life. It's a much simpler life, and your choices are far more limited than they would be in South Africa. But you have that aspect to it, which is has a certain charm to it. Taxes, okay, no CGT, no state duty, you can build wealth. You now need to be very careful not to earn income, okay, because now then you're back to square one to the same rates as South Africa. Whether that's going to change once COVID and economies improve. I mean, Mauritius is in a bit of a desperate situation because one of its biggest pillars of the economy, which is tourism, is basically dead and will be for another year. So it's really, needs to raise money, and it's raising money from the people that have money, and it's not what you want to hear. So your taxes are on the lower side if you structure your affairs carefully. If you don't structure affairs carefully and you earn everything as a high income earning salaried employee, or you don't structure your business carefully and everything's in your personal name, you're going to pay quite high taxes. That's the bottom line. Particularly if you if you need that money for consumption. If you put it into structures and you don't access it, then your taxes come back down to 15%, which is very affordable, even lower. There's a certain simplicity of life. So if you enjoy the simple things in life, you enjoy good weather, and Mauritius, yes, January, February, March, the weather's harsh. I mean, it's very humid, it's very hot, it's not pleasant. You may like that kind of thing. And again, you can, if you choose to live on the beach, you're going to suffer because the weather on the beach is a lot more humid and hot than living a little bit inland, 100, 150 meters above sea level, where it's a lot more pleasant. There's certain parts of the island which get positively cold in winter. But it is a hotter climate than South Africa, far more humid climate, but really from about April, May to December, the weather's fantastic. Okay, it's a bit more rainy than what you'd be used to in South Africa, a bit more of a Durban type weather, but it's very pleasant. You basically don't have a winter. You're going to have some fresh evenings, but you'll never need to, you're unlikely, if you live by the coast, you'll never really need to put a jersey on for the entire year, in maybe barring a few days of the year. So if you enjoy the warm weather, you enjoy blue skies, you enjoy the beautiful light, you enjoy the beach, you enjoy, there's a lot of natural scenery, mountains, people are relatively relaxed. You don't have this angst, this rage, road rage, you don't have that kind of thing in Mauritius, certainly comparatively to South Africa. So it's a more chilled existence. And if that suits you, Mauritius is a good place for you. Okay. We've got BE in South Africa, which I found with a lot of my clients is a big reason why they're packing things up and moving out, because they're not prepared to give 51% ownership to Black economic empowerment. You don't have that in Mauritius. Yes, we do have a nationality-based bias in terms of owning residential property, which South Africa doesn't have. So that on the negatives, that's the one thing that you do have. But here, whether it's a local business, if you get involved into local business activity or any kind of business activity, there's no barrier to entry because you don't have the right color of ownership or employees in your company. No exchange controls. Okay, so exchange controls are lightening up a lot next year in South Africa. What that will look like, we're not sure yet, and hopefully it's going to be a good thing. But it's been a big issue for a lot of wealthy South Africans. Exchange control regulations. You don't have that. You can have your dollars, pounds. You can do what you like. So those are a lot of the positives. There are other positives that are very personal that you may find. I'm just trying to deal with the general positives, and I think those are the positives relative to South Africa that you would enjoy. Okay, so now let's look at some of the disadvantages. I have mentioned property ownership restrictions. Okay, for some it's a big issue, for others it's less of an issue. I really hope that one day Mauritius will permit each foreigner to own one property over a certain value, not on the beach. In other words, I understand why it's there. It's there because if you're a small population or a small country like this, if you allowed foreigners to buy all the property, the prices become sky high and locals just wouldn't be able to afford property. Because it's limited, you've got the limitations of the landmass, of this coastline, but I still believe that you can allow South Africa, for foreigners to own a property, that they can choose how to build it, how big to make it, where to have it. Because at the moment you're restricted to pre-designed, pre-developed PDS schemes, which are really expensive for what they are. And eventually living in a country and you can't, or you don't own your property, you're renting all the time, doesn't feel like home. So if you've got the means to buy $1 million property, $2 million property, great, but a lot of us don't. So that's definitely an area that you just got to be mindful of, and it's something you've got to come to terms with. That's part of the deal of coming to Mauritius at this point in time. Higher cost of living, okay? You may pay lower taxes if you structure your affairs carefully. It could be significantly lower than in South Africa, and you can build wealth without capital gains tax, without estate duty, things of that nature. But it's a higher cost of living. How much higher depends on how you live. But, rent is expensive in Mauritius. To live in a reasonable home in Mauritius, you're going to look at 40,000 Rand a month for a 3-bedroom, reasonable property to rent, at least. Cars are very expensive, unless you're prepared to drive a little 1,300, 1,600cc vehicle, or maybe a double cab, which has a lower price tag because it's zoned as agricultural for duty purposes. If you want to, the 3 Series BMW that you may have cost you, I'm not quite familiar with prices anymore, whatever it costs in South Africa, it's going to cost you triple in Mauritius, triple. So food and alcohol, 2 to 3 times more expensive. So, it depends how well you want to eat. But it's definitely a higher cost of living. If you factor the tax and you've structured your tax, and if you obviously earn a lot more than what you require for your standard of living, then sure, it's going to be great. Okay. If it's been tight and you're not getting a big tax break here and you're thinking, am I going to be able to make it in Mauritius? I'm saying to you, it's going to be expensive. It's an expensive place to live. And remember, schooling is expensive here. Any expatriate English-speaking schooling, it's expensive. It's not much cheaper than the most expensive schools in South Africa. Schooling is expensive and your options are fairly limited. So if your kids are still going to school, particularly high school, that's going to be something that is going to be, something to ponder about. A big one is that if you're used to the kind of retail experience, shopping, restaurants, entertainment, sport, you don't get it in Mauritius. It's a little third world island, okay? A couple of slightly first world elements to it, but it's a third world island. You're going to need to enjoy the simple lifestyle. Golf is great. Diving, the beach, water sports on the sea, those are all great, okay? If you're looking for for your kids in particular, for the rugby, for the tennis, for this, for that, you've got a bit of tennis in Mauritius, but it's, the competitive sport's basically non-existent. It would be nothing like what we're used to in South Africa. And that does impact on the whole schooling experience for your children, where if that's important, those other elements other than strict academics. Retail. I go to South Africa with one empty suitcase and I come back with it full, because you just don't find stuff here. And, yes, you can buy a lot of stuff online, but a lot of them don't deliver to Mauritius. So that's more of a challenge. It's not to say that you won't find the basics here, but depending what you enjoy and how much retail is a big thing for you, you'll have to do that retail when you're traveling. So it's comparative to South Africa, your retail experience is much, much less. Educating children, okay? I'm not saying that there aren't options. There are 2 or 3 schools in the north, 2 or 3 schools in the west, 1 in the middle of the island, English-speaking schools. The standard of education from an academic perspective is pretty good. It's, I'd say, as good as most schools in South Africa. Where it's lacking is in all the other life skill training. There's no sport to speak of. There's no, there isn't that vibe and that element that we have in South Africa with the schooling system, with the competition, with the chess club, with the this club, with the that club, with the that. You go to school, and then after school, you've got to drag your kid around to find the piano lessons, to find the this lessons, the swimming lessons, the that lessons. It's an issue. And it even got to the stage where my eldest, my son, I sent him back to boarding school in South Africa. My girls are very happy here. We've got 2 girls. They're 2 different schools because they're very different and they have different needs, but they're both very happy here and they're great schools. But my boy didn't work out and he's gone to a boarding school, a well-known boarding school in South Africa. Your expat community is limited. You will see the same people over and over. You're not going to be going to places and meeting new people that much. It may be a good thing, a bad thing, depending what you enjoy. So you do get cabin fever. Do you feel a bit claustrophobic after a while and you need to get off the island? Okay, and you can't just drive up to Dahlstrom or fly down to Cape Town for the weekend type thing. You got to go and travel internationally. There is an element of limited civil rights as a non-citizen. Just understand something, and this is a bit of an issue. You're unlikely to ever get a passport. There are some, in theory, ways to get a passport, but for all intents and purposes, I've found in my experience that you're not going to find you're not going to get a passport. So you're always going to have to rely on those permits. And if something happens, if you have an altercation with a local, if you run over a local person, you've got issues because you don't have the same civil rights that a local has. And that becomes an issue at that level. So I'm not going to go into further detail than that, but that is something that's a little bit of a concern about living in Mauritius where you're not a citizen. The language may be an issue. I mean, you can get by with English, but really if you can speak French, it expands your expatriate community massively, your social circle. You can go into shops and you get by with English, it's okay. But, you don't necessarily feel like you're at home because, French and Creole are the languages that are spoken, and English is not widely spoken by the general populace of Mauritius. Yes, the educated, the affluent will. There are also a lot of French people from France. They don't like speaking English at all. So there's a very Frenchified kind of atmosphere here. And you just need to embrace that. Don't try and compare Mauritius to South Africa. You've left South Africa. If you leave South Africa, you leave South Africa, because it's all fine and well to remember the good stuff and forget about the bad stuff about South Africa. There's a reason why you left if you chose to do that. So when you come to a new place, just need to embrace what there is and adapt to what there is and have more of a fit-in type of mentality rather than, oh, but that's not the way we did it back in SA type thing. And that, I think, that kind of attitude would make you enjoy the country and start to feel at home in the country a lot quicker. Obviously, family holidays are expensive. You only so many times you want to go to a hotel here, and they're expensive anyway. And quite frankly, it's more comfortable being at home. So when you get away, it costs, and that's built into your budget. And I should have maybe ended off with the advantage or the disadvantages. In short, my experience has been very positive in the main. I've been here for 12 years. I have no regrets. I do not miss South Africa as such. I do go back there regularly and see friends and some family. But I have had no regrets about my decision to come here financially, personally, for my kids. My kids love Mauritius. They don't want to go anywhere else. We go away for 2-3 weeks somewhere in the world. They're dying to come back to Mauritius. Whether Mauritius is going to be the long-term place for them to be is another question. Where they're going to study and have tertiary education, that's another story. But it certainly ain't going to be South Africa either. So, it may well be that Mauritius is an interim location for you. You come here, you have a 10-year plan, you make your money, and then you retire wherever your kids happen to live, which could be anywhere else in the world. Those are just my ideas. Thank you very much. I've now exceeded the 1.5 hours. Those are my details and my website. You're welcome to send me a question by email. I see, have I put my email address? Yeah, mark@kortenconsulting.com. Website details. If at any time you feel you have a quick question to ask me, I'm happy to answer it for you. Thank you very much for your attendance. Goodbye.